A very good morning, friends. So I hope you're having a good time pre-Diwali as well. But I think it's a wonderful time to make the best use of the time as well. So previous session, we started a revision on Indus 115 that was on revenue. And today the focus is on Indus 116 that is on the lease standard. I think this is again a very important standard from the examination point of view. And I think typically when you come to the calculations, typically on the concept of modification of lease, it involves a lot of tedious calculations and all. So again, what I have done, I've selected a total of 20 super questions with you. The idea, of course, is that once we make a walkthrough of all these questions, you should be able to get a good grip on the standard. But of course, there will be a need, of course, to make, you need to do some more questions as well. I mean, just doing these questions is not the entire game. But of course, the idea from my side, of course, is that once we do these questions, the entire concept, takes a complete revision at your end. So I think I'm again going with the presumption that, of course, you know the lease standard. So you know what we're going to do? Quick mind maps in between after we have done some few questions with you. So we're going to start a journey. If I think I divide the standard Indus 116 in terms of certain blocks, I would say the first area is, of course, identification of the lease. Because at the first instance, what you need to do, you need to identify that a given agreement, a given contract is a lease agreement or not. Because if it is not within the purview of this standard, you cannot progress further. Once we understand the inputs in terms of identifying the lease, the second focus point is also considering that a contract may have multiple components, lease components, non-lease components. And of course, we know that Indus 116 would apply only to the lease components and not to the non-lease components. So how do we segregate the lease and the non-lease components so that we can accordingly do the accounting for the lease and non-lease components? That becomes a little special issue in terms of 116. The third focus area is, of course, on the core accounting, accounting in the books of the lessee as well as accounting in the books of the lessor. So I would say that becomes a block number 3. And then I would say the block number 4 is going to comprise of certain special issues in terms of subleases, in terms of sale and leaseback transaction. So when you're revising your concept as well, what you need to keep in mind is that the entire standard is almost divided in terms of 4 blocks of issue. One is in terms of identifying that a given agreement is a lease or not. The second is in terms of lease and non-lease components being segregated and accounting. Then the third is in terms of the core accounting, which is accounting in the books of lessee as well as the lessor. And finally, coming to the special issues, which is sublease. And I think typically the most important, of course, is the sale and leaseback transactions, where we generally falter in terms of getting the figures. And of course, in between, when we're going to talk in terms of the books of lessee, of course, the area on modification of lease also becomes important as well. So I think with that inputs in hand, let's begin the journey. Let's, I think, first do a question on identification of the lease. So I've just increased the font size a bit as well, so you can see the questions clearly. So let me know, friends, on the chat box, if you can see the question clearly. The visibility is good to go. I hope no challenge in terms of looking at the question. I have changed the font size for a better experience. That's great. Okay, so I think we're good to go. Let me now read the question with you. So we're looking at question number 1, where there is a scenario number A. So let's read the facts of the case. It says an electronic data storage provider, that is the supplier, provides services through a centralized data center that involves the use of a specified server number 10. I think the words which I'm underlining, typically centralized data center and the specified server, I think that would definitely give you some kind of insight in terms of deciding whether it's a lease or not. The supplier maintains many identical servers in a single accessible location and determines at the inception of the contract it is permitted to and can easily substitute another server without the customer's consent throughout the period of use. So it says that the substitution can be easily done, and that is also without the customer's consent throughout the period of the lease. Then it says, further, the supplier would benefit economically from substituting an alternative asset because doing this would allow the supplier to optimize the performance of its network at a only nominal cost. In addition, the supplier has made it clear that it has negotiated this right of substitution as an important right in the arrangement. And the substitution right affected the pricing of the arrangement. Whether the substitution rights are substantive. So the question is that are these substantive rights, substitution right substantive? And do we say that there is an identified asset? Okay, I get the request. So can we get the first mind map as well? Okay, so we can link to the concept. I think we decided that we're going to make some mind maps after the questions are done. If I give that in pre-hand, I'm comfortable. But I think let's do it after the end of the questions. Once we cover the concepts, I give you some quick mind maps on the concept to be applied. What do you say? Good idea? Okay, so I think let's get the inputs on your side. You've read the facts of the case. So what do you say? Is that supposed to be a lease or not? Rather, I would not say that it is a lease. I got the answer. Yes, the substitution rights are substantive. In this case, it is not an identified asset and it is not a lease. That's exactly, absolutely correct. I think, let me just, quickly give you the inputs as well, though I think we can do the documentation of the mind map later. I always tell people that when you're looking at an arrangement, whether it is a lease or not, you could simply apply a three-step model. I think I'll just quickly run the three-step model as well, do the documentation of the mind map later. The first is in terms of step number one, you need to see that there is an identified asset. Now, within the step number one, when you say that there is an identified asset, I would say there are three pertinent questions to be applied. So I think in this particular case, what we're looking at is only the application of the step number one. And that is looking at whether there is an identified asset. Looking at the fact that there is an identified asset. And in this particular case, I would say there are three parameters, or you can say three sub-steps, which you need to apply. The first one is you need to see that is there an explicit mention. The first one is to see that is there an explicit mention about the asset in the agreement. Now, sometimes there may be an implicit mention of the asset in the agreement and there may not be an explicit mention. But I think on the parent front, let's go with the fact that there is an explicit mention in the agreement about the asset. And if yes, the second focus and the third step, they both are going to look at the concept of supplier substitution rights. The next one is looking at the second and the third sub-step is looking at whether the supplier has got a substantive substitution rights. Now, when you look at the fact that the supplier has got a substantive substitution rights or not, you need to look into the two factors. One is you need to see that is he got a single asset or is he got multiple assets of the same kind. If he's got a single asset, in that particular case, substitution is not possible. And therefore, if the substitution is not possible, we're ready to go to the step number two and see whether it becomes a lease or not. But if you say that there is a presence of multiple identical assets with the supplier, it puts him in a comfortable position to do the substitution. But then we need to go and see the third step, which is looking at the location of the asset. And when you start looking at the location of the asset, in that particular case, we need to see If the asset is located at the supplier's place, he is in a comfortable position to substitute without incurring any, you can say, larger amount of cost. But the asset is located at the customer's place, then in that particular case, it would not be possible for the supplier to do the substitution without incurring a major substantial cost. So in this particular case, when you say that the step number one is met, when you say that the step number one is met, the first is you prove that either it is a single asset. Then the step number one will get met. We can say, yes, there is an identified asset and the supplier's rights are not substantive in nature. Or when you prove that there are multiple assets and you also prove that the location is at the supplier's, at the customer's place, then also we can say that the substitution rights are not substantive. The only condition, the only situation where the supplier's right is going to be substantive is number one, when you say that he has got multiple assets with the supplier and the location of the asset is supposed to be at the customer's place, then we can say in this particular case, the supplier's substitution rights are not going to be substantive. So I think let's apply these parameters, though I think you've already given me the answer, but let me still apply the parameters to take it further. So in this particular case, I am coming back to the inputs. Now we can see, first of all, when it makes a mention that there is a specified server number 10. So when it says there is a specified server number 10, this indicates the explicit mention of the asset in the agreement. So I would say the first sub-step gets met. The agreement has made a very clear-cut mention regarding the specified asset. And then it also makes a mention very clearly that it can easily substitute the asset, and that also without taking the consent of the customer. But then there is a more elaborative explanation which is followed when he says that in this particular case, as far as the supplier is concerned, he's clearly said that he has got multiple assets of the same kind. I guess we are given very clearly he's got many identical servers out here, which means he's got multiple assets out here. And when it says that it has got multiple assets, the next one it says very clearly that there is a centralized data center. And the centralized data center means that it is at the accessible location of the supplier itself. So we can say the location in this particular case is at the supplier's place, centralized. The word centralized means that the location of the asset is at the supplier's place. So now if you look at the chronological order, explicit mention of the asset in the agreement, 1, multiple assets with the supplier, 2, and number 3, the location is at the supplier's place. Easily substitution can be done. So we can say the substitution rights of the supplier becomes substantive in nature. And if that becomes substantive in nature, the step number 1 would fail. There is no identified asset. So I think if we answer the question, whether substitution rights are substantive, yes. And is there an identified asset? No. I hope you got the point. Giving you the explanations in terms of the parameters in this case. Warm-up exercise, we're just looking at identification of the lease. Let's go to the next part now. There's another scenario number B as well. Continued with the same question. Let's have a look at the scenario number B as well. Okay, so let me take you to the next input in this case. It says, assume the same facts in scenario A, except that server number 10 is customized and the supplier does not have the practical ability to substitute the customized asset throughout the period of use. Additionally, it is unclear whether supplier would benefit economically from sourcing a similar alternative asset. So it says it is unclear whether he would get economic benefits by making any substitution. Whether the substitution rights are substantive and whether there is an identified asset, I think you'll easily give the answer to that part. I think in this particular case, he's already used the word that there is a tailor-made, a customized asset in this case. Can I see if there is a customized asset? It indirectly means that that is the only asset the supplier has got. And if that is the only asset the supplier has got, then I think in that particular case, substitution is not technically possible. Supplier's right to substitution would not be substantive. And I think in this particular case, we will say, yes, there is an identified asset. You get ready to go to the step number 2. And that's right, no substitution as the rights are not substantive. That's correct. So whether substitution rights are substantive, no. And is there an identified asset? I would say yes. We are ready to go to the step number 2 in that particular case. So don't worry, I'll just give you a quick mind map after the second and the third step is done. We'll just consolidate the parameters which we need to keep in mind in terms of identifying the lease. Let's go to the question number 2 now. There is again a continuation of identification, whether it's a lease or not. It says company M enters into a 15-year contract with power company P to purchase all of the electricity produced. It says all of the electricity produced by a new solar farm. P owns the solar farm and will receive the tax credits relating to the construction and the ownership of the solar farm. And M will receive the renewable energy credits. So the tax credit is going to the owner and the renewable energy credits are going to the, you can say, user, who has got the substantial benefits from the solar farm. Now, one of the parameters which is there in terms of deciding whether it's a lease or not, that is the step number 2, is to look at who gets the substantial benefit from the use of the asset. Now, there are 2 important keywords. I think let me just pen down the thoughts as well. So when you're looking at the step number 2 in terms of identifying the lease, the focus is who gets the substantial benefits. The focus is to see who gets the substantial benefit from the use of the asset, mind you. So there are 2 key focus points in terms of the step number 2, that the substantial benefits from the use of the asset goes to whom. So in this particular case, if you say that the substantial benefits will go to the supplier, undoubtedly it is not a lease. But when you say yes, it will go to the customer, then in that particular case, we're ready to go to step 3. I cannot say that it is a lease at this stage because there is a third step as well, where you need to look into the decision-making rights as well. Because step number 2 and step number 3 put together is the largest step, which looks at the control test for the identification of lease. So in the control test, you need to see that the benefits should go to the customer. And in the third step, the control test, you need to see the decision-making right should be with the customer. In this case, we're focusing only on step number 2. Now, the other important thing is that when you're looking at the substantial benefits, the substantial benefit should arise from the use of the asset and not from the ownership of the asset. So I think it'll be a good idea that when you read the case study, you also filter out and tell the examiner that these benefits are arising out of the use of the asset and these benefits are arising from the ownership of the asset, and also give a clarification that those benefits arising from ownership is not important to do the analysis. Your identification, whether it's a lease or not, is not focusing on the benefits which comes out of the ownership of the asset. So they will not be a deciding criteria whether it's a lease or not. So let's get back to you and see what is the input. So he said M is only getting a tax credit as a part of the capital, and this is not economically benefit. So lessee has economically benefit by the lease. Right. So I think I'll put it like this, that we can see 3 kinds of benefits which are there in this particular agreement. One is the electricity produced. So we can see the benefits is, one is the electricity produced. The second is the tax credit. And the third is the renewable energy credit. You can of course tell the examiner at the first instance that what does the standard states, keeping the three parameters which I said earlier in the previous session. What the standard states, that is one. What are the facts of the case relating to what the standard states, and then give you a conclusion. So we can filter out that there are three benefits which are defined in this particular question. As far as electricity produced is concerned, it is going to the customer. And as far as the renewable energy credits are concerned, that is also going to the customer. But as far as the tax credit is concerned, this benefit is going to the supplier, but this benefit is arising on account of ownership. And since it is arising out of ownership, it does not make any difference to the analysis. So we need to consider that the benefits which are going to the customer is in terms of electricity produced, one, energy credits, that is two, and the benefits of tax credit is arising not out of use but out of ownership. Therefore, it's not taken in the analysis. And if you want, you can also add more inputs to your solution, that when you look at the concept of substantial benefits, we can say it is not only the main benefits, but also the byproducts which should also go to the customer. In this case, the main benefits would be in terms of electricity produced, and you can say the byproduct would be in terms of the renewable energy credits. And once you say that both the benefits, the main benefits and the byproduct benefits, which is the energy credit, goes to the customer, we can undoubtedly say the step number 2 is met. But we're not saying it's a lease, because there is another third step which will also follow on that. So when it says who has got the substantial right benefits from the asset, undoubtedly we can say it is to the customer. So you're ready to go to the step number 2. Wonderful. So that takes care of the step number 2 in terms of identifying the lease. Now we're ready to go to the third step. Then I'll pen down the inputs to you. So I hope the font size today is good. There is no problem in terms of looking at the questions. I hope so. I've just, changed the font size as well so that you can look at the question and I can, completely write on the board itself. Okay, let's, I think, look at the question number 3 now in this particular case. Now, before we read, let me tell you, now we are focusing on the third step, which is in terms of looking at the decision-making rights. It's a part of the control test where you need to focus on the decision-making rights. Is it with the customer or is it with the supplier? And accordingly, you decide now whether it's a lease or not. Let's read. It says entity X, the customer, enters into a contract with a transport agency Y. So company X is the customer, Y is the supplier, because until you decide that it is a lease, we always call the lessor lessee as a supplier and a customer. It says to use a particular truck which is specified in the contract for a period of 5 years. Entity Y can substitute another truck only in case of a breakdown of the truck. As per the terms of the contract, during a period of 5 years, the driver hired by entity X can operate the truck, and the entity X decides how to use the truck, such as when it is used and which goods will be carried and on which route to operate. So when will it be used, which goods will be carried, and which route will it operate? So all these decisions are taken by entity X, that is the customer. However, there are certain contractual limitations to protect the interest of entity Y in the truck. There is restrictions on account of moving the truck to overseas or making modifications. Whether entity X has got the right to direct the use of the truck or not. I think let's get the answers from your side. So what do you say in this particular case? Is the customer getting the DMR, that is the decision-making rights? Okay, so I think I get the answer. Entity X has the right to direct the use of the truck, and it is not substantive as well. That's right. And I think the second input given is also great, that it is supposed to be the rights of Y are supposed to be protective in nature. That's great. Absolutely correct. So I think I'll just, quickly pen down the thoughts. So in this particular case, the focus is now looking at the step number 3, which is the control test, and I call it as DMR, that is decision making rights. So in the step number 3, when you're looking at the identification of the lease, your focus is in terms of decision making rights is with the supplier or the customer. Now, when you're looking at the decision making rights, and you reach a conclusion that it is with the supplier, of course, in that case, it is not a lease. But when you reach a conclusion that it is with the customer, of course, it becomes a lease. But at the same time, you also need to make a mention that sometimes these suppliers may have certain rights. And those rights are something what you rightly called protective rights in nature, which is not going to take away the rights of the supplier, but at the same time, give the supplier something which we can say protective rights in nature. So when you reach this input, you also need to see that there could be certain restrictions on the customer, and you need to evaluate whether these restrictions are something which is giving a protective rights to the supplier. So if it is giving protective rights to the supplier, it would not interfere. It would not interfere with the decision making rights with the customer. So I think in this particular case now, let's, I think, go back and look at some basic inputs again. So one thing is very clear, that we are very clearly given that it is a truck which is specified in the contract, and it very clearly says that substitution would be done only if there is a breakdown. So I think if I correlate these particular facts, we can go to the step number 1 and decide that yes, there is an identified asset. There is an explicit mention in the agreement, that's one. And we can clearly see that substitution rights are not there unless there is a major breakdown. So we can say in terms of step number 1, there is undoubtedly an identified asset. I'm not given any direct inputs in terms of the step number 2, that whether the economic benefits from use will go to the customer. But I think since he's got decision making rights, I think that second step gets presumed to be a yes. Then he says that he can operate the truck and decide how to use it. So I think the decision making rights is all about how and when. When you look at the decision making rights, the decision making rights is all about the concept of how and when, how the asset will be used, when the asset will be used. So we can say in this particular case, when you say how and when, in those cases, the customer gets the right that how and when to use the asset. He's got exclusive rights. But of course, there are certain contractual limitations as well. But when you look at these contractual limitations, these are merely protective rights by the supplier. He is only restricting the customer not to move it to overseas or make any modifications. So these contractual limitations are only protective in nature, cannot snatch away the decision-making rights of the customer. So undoubtedly, we can say whether the entity has the right to direct the use of the asset. The answer becomes a yes in that case. Okay, you want me now to make a quick mind map on this particular part. My block 1 is over. We've decided the parameters on the basis of which you decide whether it's a lease or not. Now you want me to make a quick mind map on the 3-step model, identifying the parameters, whether it's a lease or not. I think definitely yes. Let's do this. Yes, since it is an identified asset, there is a lease. That's right. So I think let me do one thing. Let me just make a quick first mind map to you at this stage. So we'll pen down the inputs in terms of a small mind map. And this is with regard to identifying the lease. This is with regard to identifying whether a given agreement or whether a given arrangement is supposed to be a lease or not. So I would say the first step is looking at the fact that there is an identified asset. I'm just going to give you some key inputs. So the first thing is to look at there is an identified asset, and when you see that there is an identified asset, I would say there are three sub-steps which you need to look at. One is you need to see that there is either an explicit or there is an implicit mention of the asset in the agreement. Invariably, you would see that there should be an explicit mention about the asset in the agreement. The second input is, and the third input is put together, suppliers, the supplier's substitution rights. The supplier's substitution rights are not substantive. You need to basically prove that the supplier's substitution rights are not substantive if you need to go to the step number 2. And in order to prove the fact that the supplier substitution rights are not substantive, you need to look into two things. You need to see whether he's got a single asset or whether the supplier has got a multiple assets. If he's got a single asset, you're ready to go to step 2. Because in that particular case, the substitution cannot be done. So when you say that it is a single asset, substitution is not technically possible. You go to step 2. But if it is a multiple asset, you need to go and see the location of the asset. And in terms of the location of the asset, either it is located at the supplier's place centrally, or it is located at the customer's place. That's how the thought process would get addicted. So when you say that it is at the supplier's place, substitution is going to be easy, and therefore generally it will not be a lease. But if it is at the customer's place, we're ready to go to step 2, because substitution is going to be an expensive proposition. So you can make your own permutation combinations. Single asset, step number 2. Multiple asset with the location at the customer, step number 2. Multiple asset with the supplier's location, it's not lease. So we can say there is one particular case, where we can see multiple asset at the supplier's place. That's not going to be a case of lease. Single asset, yes. Multiple asset at the customer's location, yes, we're ready to go step 2. When you look at a single asset, you can also say single asset would also mean that it could be a tailor-made, a customized asset as well. A tailor-made or a customized asset will be construed as a single asset itself. And then we go on to the step number 2 and step number 3. And in terms of the step 2 and 3 put together, the largest step, we can say this is nothing but it is a control test. The step 2 and 3 put together is what we call a control test. In terms of the step number 2, you need to see substantial benefits. You need to see that the substantial benefits, and that is from use of the asset, that should go to the customer. That is the focus in terms of step number 2. The substantial benefits coming from the use, not from the ownership, goes to the customer. And the third step is what we call decision-making rights, DMR. So we call this as decision-making rights, part of the control test itself. And in this case also, it should go to the customer. So step 2 and 3 put together becomes the control test, where you need to see the benefits goes to the customer 1 and the decision making right goes to the customer, there is 2. Then we reach a conclusion that yes, it is a lease. Right, friends, I think I've penned down the thoughts as well. The mind map is done. Right, ready to go to the next level now? Wonderful indeed. That's great. Now we're ready to go to the next area of discussion, that is on the accounting part. Okay, so let's, I think, go further. My block 1 is taken care. Now we're going to go to the block number 2. Okay, I think we can maybe skip this question that's on the block 1. Okay, now this is an interesting question to put across. We're now coming to the second area of discussion. I hope the question is visible. So I want to capture the screenshot of the mind map. Okay, I'll just give it to you once again. No worries. Yeah, please go ahead. So now we're going to focus on the next area, and our next area of discussion is going to be in terms of lease and non-lease components in this case. So I think before I go to the question, I think just let's take a quick recap in the mind. We can make the mind map later, but I think just have a little quick look on the inputs. Now, when you're looking at the concept of lease and a non-lease components in an agreement, the focus point is very clear that number one, all assets would be lease components and all services in a contract is going to be non-lease components. But you need to see that is every asset a lease component or not? And is every service going to be a non-lease component or not? So the basic first thought process which should come to your mind is filtering the lease and the non-lease component. The moment the agreement talks of multiple assets, there could be multiple lease components. The moment the agreement talks of multiple services, there could be a non-lease components. But at the same time, when you're looking at the lease of assets, there is a lease components, you need to see that is every asset going to be a separate lease components or not. And for that particular purpose, what you need to filter is number one, if you notice that those assets are interrelated, interdependent in nature, they're not capable of independent use. In those particular cases, you'll have to club those assets as one lease components. So you need to check the interdependency and the interrelationship, whether those assets are capable of independent use or not. So if they are capable of independent use, of course, they are separate lease components. Every asset will become a separate lease components. Otherwise, they will be clubbed as one. Similarly, when you look at the service part of the contract, you can say it's a non-lease components. Then the focus comes on the point, are we getting a benefit out of that service as a lessee? If I am getting a benefit out of that service, then it becomes a non-lease components to me. But if I'm not getting a benefits, then in those particular cases, we would say, no, it's not a non-lease components, and we will not identify that component to be a non-lease component. And once you've segregated the lease and the non-lease components, the focus switches to how would you apportion the amount of lease payment towards the lease and the non-lease components. And that's going to be fairly simple. Just the way you do it in Ind AS 115, you will consider the standalone prices of the lease and the non-lease components to apportion the lease payments. And the idea, of course, is the lease components will be accounted under Ind AS 116 and the non-lease components will be accounted under any other standard, the relevant standards you would say, but not 116. That was a little quick overview in terms of before we get with the questions started. Let's have a look at one of the questions which came out here. Okay, I think I'm getting some question as well. So please increase the quality of visibility. Looks dull. Is that so? Can please everybody tell me the input? Is the screen visible clearly to you or not? Because otherwise then I'll have to switch over and show it to you on the laptop because I've been asking that since morning. So can everybody please just give me input on the chat box? Is the screen clearly visible? Can you see the question clear? Because question 5 has got a lot of data, but other than that, can you please give me some inputs on the chat? Can you see the question visibility clear, please? Bit blurry, but manageable. You want me to, show you the question on the screen in that case? I can do that. Okay. Maybe we'll just increase the font a bit more because this question has got a lot of data and it's a little difficult, fit it into one single screen, that one. Okay, so I think I'll just show you but previously the questions we have done, I hope the screen was clearly visible, right? So whatever questions we have done earlier than this, is that good to see now? It is good to see you. Okay, so I think for the larger questions, there might be little issue. I have, taken every question independently on separate pages, so the visibility is good. But if there is going to be a challenge, I'm going to show you the questions on the screen through my laptop. Otherwise, I think we'll do the workings out here. Okay, so let me now read this particular question. As I said, this question came in RTP in November 2020. So we're looking at a question which came in the RTP in November 2020. Let's, I think, read this question now. It says entity X, lessee, entered into a lease agreement with entity Y. So X is the lessee and Y is the lessor to lease an entire floor of a shopping mall for a period of 9 years. The monthly lease rental is 70,000. To carry out the operation smoothly, entity X simultaneously entered into another agreement, that is facilities agreement, with entity Y for using certain other facilities owned by entity Y, such as passenger lifts, DG sets, power supply infrastructure, parking space, etc., which is specifically mentioned in the agreement for a monthly service charge which is amounting to 1 lakh. As per the agreement, the ownership of the facilities shall remain with entity Y, and the lessee's incremental borrowing is given at the rate of 10%. Then it says the facilities agreement clearly specifies that it shall be coexistent and coterminous with the lease agreement. The facility agreement shall stand terminated automatically on the termination or expiry of the lease agreement as well. So we can clearly see that there are basically two components in the agreement on a very apparent level. One is, you can say, the space in the building, and one is, you can say, the services in the form of passenger lifts and escalators, etc. So that seems to be, a non-lease component separately. Entity X assessed that the standalone price of the agreement is 1,20,000 per month, and the standalone price of the facilities is 80,000 per month. So you are given the standalone prices of the space as well as the facilities. Entity X is not elected. Entity X is not elected the practical expedient in para number 15 of 116 of not to separate the non-lease components from the lease components, and accordingly it separates the non-lease components from the lease components. How will the entity account for the lease liability at the commencement date? But I think first what we need to understand in this particular case is, are we considering the building to be a separate lease component? And are we considering the facilities agreement as a non-lease component? What do you say? I think as far as the building is concerned, it's a single asset. Undoubtedly, it becomes a lease component because one asset would definitely mean one separate lease component. The only input to be seen is regarding the facilities agreement. Do we consider that to be a separate non-lease components or not? And I get the input lease components and non-lease components in this case. That's right. I think if you look at the facilities, as a customer, when you're making a payment for these facilities, are you going to get benefits out of these services? Undoubtedly, yes. So we can say the total lease rental which you're making a payment has to be segregated, and that would be in the ratio of the standalone prices. So let's do a little working. So we can first of all see what is the total rental which we paid. The lease rent is 70, and we are also given the lease rent is 1 lakh. Now, a quick question to you. Do we accept the value which is written in the agreement and say that yes, this is for the lease and this is for the non-lease? Do we accept it or do we challenge it? Do we accept the bifurcation which is written in the agreement, that what is being paid for the asset and what is being paid for the facilities, that is service? Or do you challenge it and you say, no, we are going to split it in the ratio of standalone prices? We overrule what is written in the agreement. What do you say? And that's right, we'll not accept the agreement because The lessor lessee is free to make any kind of arrangement in the lease, but we're not going to accept it from the accounting point of view. So what we're going to do in this particular case, 70 is paid for the building and 1 lakh is paid out here. So the total payment is made is 1 lakh 70. And this is to be segregated between the lease and the non-lease components in the ratio of the standalone price. And I think if you look at the ratio of the standalone price, 1 lakh 20 is to 80. So divide this in the ratio of 120 is to 80. So this is the ratio in which the lease and the non-lease components will be segregated. So 1 lakh 70 divided in this ratio, I think this is coming to 1 lakh 2,000 and this is coming to 68,000. This is paid for the non-lease components. And this will of course be accounted under the lease standard, that is Ind AS 116, and this will be accounted under other standards, not under the lease one. And since you're already given the value of the incremental borrowing rate, one can calculate the present value of these lease payments and put the journal entry which is done. So normal accounting in this particular case would follow. The basic idea was to give you the parameters of segregating lease and non-lease components. You want me to give you a quick mind map on the segregation of the lease and non-lease components as well? I think I've got another question also on that area. No, this is different. This is different one indeed. So you want me to give you a quick mind map on that as well? So, or this is good to go, or you want me to quick mind map on the segregation of lease and non-lease? We go with the majority opinion. If you say yes, I'll quickly make a mind map. And yes, okay, then I think let's make a quick mind map on this area as well. So we are making a second mind map as well, and that is on separating the components. That is on the concept of separating the components of the lease. So when your focus is separating the components, I think let's make one wonderful chart in terms of lease and non-lease components parameter. So we can say there will be two elements. One is when you're looking at the presence of assets in the agreement, and one is you're looking at the presence of services in the agreement. The presence of assets would mean that we are focusing on the lease components. We are focusing on the lease components. And when you're looking at the presence of services, the focus is on the non-lease components. So remember, the assets are always taken as lease components and the services in the agreement is going to be taken as non-lease components. Now, when you look at the assets and you say that there are multiple assets in this case, then there is a need to put a small little question, and that is, are they capable of independent use? Are they capable of independent use? And you can also put a question that are they interrelated or interdependent? Are they interrelated or interdependent? So these are the two questions which you need to put across when there is a presence of a multiple assets, that are they capable of independent use? Are they supposed to be highly interrelated, interdependent? Now, if you say the answer yes, then in that case, you need to combine all of them as a single asset. Of course, we're looking at the two assets will be combined. So you say, oh, sorry, if you say yes, they are separated, my mistake. If they are yes, then you need to treat them as separate components. Every asset will be treated as a lease components. But if you say no, they are not capable of independent use. So basically it is, if you say this as a yes actually, and if you say this as a yes, so they are capable of independent use, separate them. If they're interrelated, interdependent, then you need to combine them. And as far as the services are concerned, in terms of the service agreement, you need to put across a question. Is the lessee getting services in return? Is the lessee getting services in return by making a payment for these services? Is he getting something back in return? So if you say yes, then you separate the non-lease components. And if you say no, we are not getting anything in return, then we do not segregate the non-lease components. And I think last but not the least, we can say it is segregated. You can say it is segregated in the ratio of standalone prices. So once you segregate and decide it is lease and non-lease components, you need to segregate them in the ratio of the standalone prices in that case. Okay, I think I get a question. So interest rate, we have seen any lessor's interest rate implicit in the contract. If no, we take the lessee's incremental borrowing rate. That is absolutely correct. Because from the point of view of the lessee, when you consider the accounting, we need to consider the interest rate implicit in the lease. If not available, that's right, we use a lessee's incremental borrowing rate as well. Right, friends, I guess this stands done. So explain the interrelationship and interdependent outcome. Okay, so I think let's put it like this. For example, if you remember, you might have done an example that there is, let's say, an HVAC system embedded in the building. Heating, ventilation, air conditioning system, which is embedded in the building. So in that particular case, the building and the HVAC system is interrelated, interdependent. You cannot segregate them. They're not capable of independent use in that case. Then we'll treat them as a single asset. So basically what you need to see, is it capable of independent use? Yes, segregate them. Are they interrelated, interdependent? Yes, don't segregate them. Treat them as one. So segregation is done only if they're not interrelated, interdependent, capable of independent use, segregate them, separate them. If they're not capable of independent use, they're interrelated, interdependent, combine them and treat them as one leased asset. Right? I hope I stand clear on the input. Okay, so this is done. Now we are ready to go to the next phase of things. This was on segregating of lease and non-lease components. The block number 2 is done. Now we go on to the next area of discussions with you. So this is now on the basic accounting part. Please let me know, friends, if this is clearly visible to you. Is this screen clearly visible? The font size, everything is good to go. Otherwise, I'll share the question on the screen. So please let me know if there is any challenge in terms of things. Good to go. I guess everybody can see it clearly. Otherwise, I'll share the question on the screen. Otherwise, in that case. Okay, I think I just got one message. It is readable. No, it's not good. Just readable. Otherwise, I can share that on the screen separately as well. So please give me your inputs. I can't decide without on the basis of the input. Please let me know if you can see it on the screen clearly or not. Only one person is giving me the input, rest everybody is silent. Can we get some messages on the screen, on the chat box, please? Readable or it's good? I don't want it readable. Readable seems to be a compromise in terms of things. When you say it is readable, it only looks as if you're saying that it is, something as a compromise that I'm looking at. If this is, not looking great, I can, share the screen on the laptop where you can see and read the question. On laptop, it is fine. Okay, then I'll share the question on the screen. So as I read, then I think you'll perhaps laptop will be clearer. That's fine. So you need to ask for it. So make bold letters. Next time I'll incorporate that as well. Otherwise, I think I'll change the system a bit. I have a little inputs also. If you want to see my face also along, I can do that as well. Oh, okay. I think you'll be able to see my face as well as I push along. No worry. I'm just going to share the question to you on the screen of my laptop as well. Just give me a second. So we are, I guess, on the question number 6 now. Okay. Yes, I hope now my face is also clearly a little bit visible as well, and you can see the question clearly as well. I think it should be now very good to go. Okay, let's read the inputs. Now, I am given the inputs in this particular case. Let me also just start underlining a few things as well. So it says company E enters into a property lease with entity H. The initial term of the lease is 10 years with a 5-year renewable option. The economic life of the property is 40 years and the fair value of the lease property is 50 lakhs. Company E has got the option to purchase the property at the end of the lease term for 30 lakhs. The first annual payment of 5 lakhs with an increase of 3% every year thereafter. The implicit rate is 9.04%, and entity H gives an incentive of 2 lakhs which is payable at the beginning of the second year, which is to be used for a normal tenant improvement. Then it says company E is reasonably certain to exercise the purchase option. How would E measure the right of use asset and the lease liability over the lease term? It's a question which came in MTP in May 2020. Okay, now in this particular case, I think the basic idea is to work out what is the values at which the initial measurements will take place. Though it's pretty simple and straight, let me, I think, first put one simple question to you. It says at the very start of the question that the tenure of the lease is supposed to be 10 years with a 5-year renewable option. And in this particular case, when it says the first annual payment is 5 lakh with an increase of 3% thereafter, then it says E is reasonably certain to exercise the purchase option. Now, can you please tell me what all will be included as a part of the initial measurement? One thing is very clear that you will definitely take the lease payment into account. The question is basically, are you going to consider the amount which is going to be paid in terms of buying the asset? The price which you're going to pay to buy the asset, would that also be captured as a part of the initial measurement of the asset and liability? It very clearly says that there is reasonable certainty that yes, he would exercise the option. Okay, I am yet to get some inputs on that. You can just spend a minute. 15 years lease term. Why 15 years lease term? The lease term is 10 years only. It says with a 5-year renewable option. He's not saying anything on the renewable option. He's only saying, okay. So the question now is, I think looking at the answer, are you considering the lease term to be 10 or 15? That's one. So if you're considering it to be 10, then I think you will be thinking that we will excise the purchase option. And if you're thinking it to be 15, then in that particular case, we would say that there's no purchase option. So let's, I think, put the question like this. What is the tenure of the lease? 10 years, 15 years, your inputs on that. Okay, I think I've got the input, only one input, it is 15 years. It's not going to be 15 years. I'm afraid this is going to be 10 years only because the purchase option is something which is reasonably going to be exercised. I think we are very clearly given the facts in this particular case that there is an option to purchase the asset at the end of the lease term, and there is a reasonable certainty that you would exercise the option. So in that case, it would be taken as a period of 10 years only. Let's, I think, do the workings. I can maybe add this out here. So let's do a slight little working. I think so far we have not been doing much computations. Time to do some calculations as well. So you'll have to help me with the calculation stuff. Or you want, I can directly take the inputs on the workings as well. Okay, so first of all, what you need to do, you need to go in for an initial measurement. I'll just show the basic calculations and we can decide the input. So we're looking at the initial measurement of the asset as well as the liability. Now we are very clearly given the inputs in the question that the lease rent which we are making a payment, it says the first annual payment is 5 lakh with an increase, it says at the rate of 3% every year. So let's take a column for year and let's take the column for the payment. And we need to do the discounting as well, PVIF, to get the present value. So let's at least show you the basic workings in this case. So can I say it would be a period of 10 years? So we'll be considering a period of 10 years. So let's, I think, work out a few payments, not all of them. So I think the first payment is very clearly given to me. It is supposed to be 5 lakhs. Now you need to tell me the second payment because there is a 3% increase and it also says very clearly H gives E an incentive of 2 lakhs which is payable at the beginning of the second year. So can I say there is an amount which is coming as a lease incentive to me? Would that lease incentive become a reduction in terms of the lease liability and the RU asset? What do you say, yes or no? And that's right. So what we can do, just add 5% to this. Sorry, first reduce that 2 lakhs and we will add, first add that 3% increase. So on 5 lakhs, you take a 3% increase minus 2 lakh, that works out at 315. Just to show the workings, this is 5 lakh, add another 3%, so into 1.03. minus the 2 lakh, it comes to 3 lakh 15. Just give me the figure for the third year, then I think we'll just directly fit in. So what's going to be the figure for the next year? Can I say on 5 lakh 15, we're going to add another 3%, that comes to 530, 450, just to show the workings. This is supposed to be 5 lakh 15,000 into 1.03. So this will keep getting compounded at the rate of 3%. I hope I don't need to show you the workings for that extra 3%. Is it okay? I have the figures with me. I'll just quickly pen them down for later reference. It is 546, 364. You just keep compounding it at the rate of 3% and so on. I think I'm not even writing the figures. And last year I'll give you 652, 387. This is how the figures of the lease payments will come. And the discounting is going to be at the interest rate which is given. The implicit interest rate is 9.04%, at which a discounting would occur. And by the way, we are of course considering the payments are made at the beginning of each year. So be a little careful in terms of using the discounting factor because the first payment is made at the beginning of the first year. So the P factor is going to be 1. And then You can take for the second year 1 divided by 1.0904. That's, I think, 0.917, and so on. And so on. So I think I'll directly give you the present value. If you multiply all this, the present value comes to 3739. It is 3739 648. That is the present value of all the lease payments. Wow. So I think this takes care of the inputs at this particular stage. This is the total. And we also have the amount paid, to purchase the asset. The amount which is paid to purchase the asset, that would also be a part of the lease payment. The amount which we're going to pay at the end of the lease term is a total of 30 lakhs, which also needs to be discounted. So 30 lakhs will also be discounted. I think I'll already give you the discounting factor that comes to 0.42. So this total works out at 12 lakhs 60. This works out at 12 lakhs 60. So now if you want the amount at which the initial measurement will take place, you add the two figures. So let's add these two figures and see what is the initial measurement. So 37, 39, 648 plus 12 lakh 60. It is coming to almost 50 lakhs approximately. Now there is a quick question coming to my mind, which I need to definitely ask you. If you notice in the question, we were very clearly given that the fair value of the property is 50 lakhs at the inception. Now the quick question is, when you took the present value of all the lease payments, including the value at which you buy the asset at the end of the lease term, that equals 50 lakh, which is the fair value of the asset. Is that by chance that it is equal to the fair value of the asset, or do you think this is generally bound to be? The present value of all the lease payments, including the amount which you're going to pay to buy the asset at the end of the lease term, is exactly equal to 50 lakhs, which is the fair value. By chance, got to be. And that's right, it is undoubtedly got to be, because invariably, when you consider the interest rate implicit in the lease, you consider fair value as a cash outflow, and you consider the lease payments and the price which you will get to buy the asset. So that will be all inflow from a lessor's point of view. So at the end of the day, when you calculate the interest rate implicit in the lease, the fair value is the outflow, and the lease payments and the price which you get once the other fellow buys the asset is an inflow. So when you take the discounting rate at which the inflow's present value equals the outflow, this is bound to be. So you will definitely notice that once you add up the present value of lease payments and the price paid to buy the asset, this should undoubtedly match with this. So indirectly you can say the examiner did a good job to you, where he already gave you this amount. The idea of doing this question was to actually prove this fact to you. Otherwise, I think the accounting is pretty simple and straight indeed. You want me to do subsequent accounting for this asset, or let it be? We've got some more larger questions to do. I think that subsequent accounting can be taken care, right? So we're adding the in every year, so it'll constitute the fair value at the end of the 10th year. Absolutely correct. Absolutely correct. Okay, so I think let's take this further. I'm now going to go to the next inputs with you. Let's, I think, have a look at another question now. Let me just try another input as well, where you can see the larger question, I guess. Now, this is a very interesting question. It's a blend. It's a blend in terms of both the things. I think, to me, the font is very clear. I don't know if this is good to go. Otherwise, I come back to the laptop for the question again. Is that good to see? Yes, very, very clear. Thank you. I think for a change, we're looking at the question with something great. Okay. Now, this is a blend of Ind AS 21 and Ind AS 116. There have been a couple of questions where Ind AS 21 gets clubbed up with other standards as well. I remember financial instruments, leases, there is some interesting questions. So this is one of the questions which came in RTP in May 21. I think if I rightly remember, this question is also there in the educational material, which is issued by the Accounting Standard Board of the Institute of Chartered Accountants. And this same question came in RTP in May 21 as well. I'll give you the trick in terms of solving this, but let's first read the question. Okay, so let's, I think, read the inputs now. It says entity X is an Indian entity whose functional currency is Indian rupee. It has taken a plant on lease from entity Y for 5 years to use it in the manufacturing process, for which it pays an annual rent. It says in arrears. Arrears would mean that this is paid at the end of each year, and that is $10,000 every year. On the commencement date, the exchange rate is 68, and I'm also given the average exchange rate is 69, and at the end of the year, the exchange rate is 70. So we're given three exchange rates. One is at the commencement date, one is at the end of the year, and one is the average rate for the year. The incremental borrowing rate on the commencement of the lease is for a USD borrowing. This is the rate which is not given for the Indian borrowing, but it is given for the USD borrowing, is 5%. How will the entity measure the right of use asset and the lease liability initially and at the end of year one? The accounting is asking you to only measure the asset liability at the beginning and at the end of the term. Now, my advice is, I always tell people that, if you're looking at a blend of two standards, typically you're looking at Index 21 and the other standard, forget about Index 21 at the moment. You just do the accounting as if all the data is in a functional currency. You're given the data in dollars, you do your accounting in terms of dollars itself. You can do the conversions later. Now, what we can do in this particular case, I'll give you the trick. So what we can do, you can comfortably make a ledger account. That's going to be far more easier. So I am looking at a lease liability ledger. Instead of making an amortization chart, I'm looking at a lease liability ledger. That's going to be much more easier. So let's take the lease liability ledger. So when I'm going to make a lease liability ledger, you can consider dollars and then you can consider the Indian rupees. So I've taken two columns. One is on the dollar terms and one is on the Indian rupee. My advice is you do the question first of all, considering that all the data in dollars is as good as functional currency. We can keep converting things in Indian rupee later. So let's, I think, begin with first of all the initial data. So if I come back on this, we are given there is an annual rent which is $10,000 every year, and we know the incremental borrowing rate is 5%. So can you quickly give me the present value factor at the rate of 5%? So we can take the entry ROU asset gets a debit and lease liability gets a credit. So we need to work out the cumulative present value factor at 5% for a period of 5 years. That's 0.952. Now we need a cumulative factor. So 1 divided by 1.05, 2, 3, 4, 5. I think it's coming to 4.3295 if I take it till 4 decimal places. It is 4.3295 rounded up to 4 decimal places. So this multiplied 4.3295, this comes to 43,925. So I've done the entry based on the fact that you are recording things in dollars itself, not even bother on the Indian rupees at this stage. Consider that this is the figure. Now what we need to do at the end of the year, we need to consider a finance charge. And this finance charge will be taken at the rate of 5% on this balance. So 5%, it comes to rounded off to 2165. I've rounded off to 2165. And then you are going to make a payment And once you go to make the payment at the end of the year, this is bank. So we make a payment to the extent of $10,000 already given in the question. So you can get the balance CD as a balancing figure. So you can notice what I've done. I've not even taken, completely ignored the fact of Indus 21 and done the question. Then we'll take care of the Indian rupees later. So 43,925 plus 2165 minus 10,000. This balancing figure is 36090. Okay. Now, once we have done this calculation, so this is, I think there's some mistake on this part. It's not 43. No, there is a little error. I think I just written the figure mistake. 10,000 into 4.3295. This is 43,295. My error. This remains the same, 2165. That is correct. So that was a writing error. That's right. Okay, now we can take the balancing figure 43,295 plus 2165 minus 10,000. This is 35,460 is the balancing figure. Now I think quick questions to you, and I think you can easily vouch me on this particular part as well. So I think let's put some quick questions to you. What is the rate at which this balance will be recorded? At the beginning of the year, on an average rate, or the end of the year? Well, this was at the commencement date, so this will of course be taken at the beginning rate itself. So we've got three exchange rates with us. The rate of exchange at the beginning is 68, the average is 69, and the closing is 70. So this will be converted at the rate of 68. What is the rate at which the finance charge will be recorded? Can I say the finance charge is supposed to be for the year? So this should be taken at the average rate itself. And the payments are made at the end of the year. Since the payment is made at the end of the year, this is taken at 70, and this is also taken at 70. And of course, there will be a difference in the ledger account as well. And can I say the difference represents the exchange gain or the exchange loss? Is this lease liability a monetary item as per Indus 21? Of course, yes. And if it is a monetary item, then where are you going to take the exchange gain or loss? Let's get the answer from your side. That's right, it is going to go in the profit and loss, because as per Indus 21, the moment you restate the lease liability, the monetary items on the balance sheet date, the gain loss will go in the profit and loss. So let's, I think, convert. 43,928 into 68. This is, I think, 29. 86,900. This is 2165 into 69. That is 149,385. And this is supposed to be 7 lakhs. And this is 35,460 into 70. This is 24, 82, 200. Now let's see what is the balancing figure. Yes, ROU asset, of course, is non-monetary. That's right. That's the reason I'm going to take that item later. So let's see what is the balancing figure. 29, 86, 900, 149, 385, 248, 200, and 7 lakh. I think we are getting a balancing figure in the ledger on which side? Says 43,295 into 68. I think I've again written this figure wrong. This is 29,44,060. This is, I think, coming to a balancing figure of 88,755. That is a foreign exchange loss, and that foreign exchange loss will be taken in the profit and loss as per Indus 21. Correct. That's absolutely correct. Great. Okay, so this is done. Now we also need to capture the ROU asset as well. I think that I'll do it directly. So as far as the ROU asset is concerned, initially that will get captured at 29,44,060. Can I say the only accounting treatment to be done is depreciate this asset? And I guess in the absence, we assume that it will be depreciated over the lease term of 5 years. And since it is a non-monetary item, no restatements are required. So we just need to consider a depreciation. So let's divide this by 5 years, and we're going to get the annual depreciations as well. So this comes to 2944060 divided by 5. I think the annual depreciation is 588,812. So that is the annual depreciation, and being non-monetary item in nature, no restatements in this particular case is required. So you can see the aspect of Ind AS 21 can always be taken at the end. You first make your ledger account considering that this itself is the functional currency, then you can keep multiplying the exchange rates at a later date and get the exchange gain or loss. This is true whether you do a question in terms of financial instruments or in terms of leases when Ind AS 21 gets blended with the standard. Great. So far, so good. I guess this takes care of the easier part of the standard. I think now comes a little complicated part where people generally tend to get a bit confused on things, and that is modifications. Okay, so I think now let's go on to, okay, there is another question which I put is on lease, non-lease. Now this one, I think I'll have to show it separately, December 21. This may not be good to look at the screen, I think. So I'll still just zoom it if this is visible, otherwise we'll go to the laptop. Is that good? No. It's okay. No, we can show you on the laptop as well. That's not a problem. Because if this might be challengeable, of course, this is good to see. But this is challengeable, I can come back to the laptop. Let's, I think, go back to the laptop. I'll solve it on the board, but let me just read it through. So let me share the screen back again. Okay, let's have a look at the question number 9. This question number 9, which we are doing, is supposed to be an examination question which came in December. So let me just read the inputs out here. So this is a question which came in December 21, 10 marks in the exam. Okay, let's, I think, read the inputs to you. It says Jacob entered into a contract for lease of machinery with Jason on 1st January 18. The initial term of the lease is 6 years and there is a renewable option for further 2 years. The annual payments for the initial term and the renewable term is also given. Initially it is 2,80,000 and it is 350 respectively. The annual lease payments will increase based on the annual increase in the CPI, that is Consumer Index, at the end of the preceding year. For example, the payment is due on January 19. It will be based on the CPI, which is available on December 18. Then he says Jacob's incremental borrowing rate at the inception of the lease is 8% and on 1/1/21 is 10% and the CPI at the lease commencement is 250 and on 1/1/21 is 260. So basically what we can see is that there is a payment and the payment is given. It says initial term, renewable terms, the payments are different. The payments are based on an index and the index is undergoing a change, and we are also given the change in the index. We're also given the incremental borrowing rate as well. Then he says at the lease commencement date, Jacob did not think that it will be a viable option to renew the lease, but in the first quarter of 21, Jacob made some major changes in the retail store, which increases the life by 5 years. Jacob determined that it would only recover the cost of improvement if it exercises the renewable option, creating a significant incentive to extend. Jacob asked your opinion whether remeasurement of the lease is required on the first quarter of 2021. So we are given some facts. I think let's just quickly go through the facts once again before we start solving. A lot of computations involved. So at the first instance, some basic input which should be clear in the mind is that you entered into the agreement on January 18. The tenure of the lease is 6 years and there is a renewable option for 2 years. The annual payments for the initial term, that means for the period of 6 years, is 2,80,000, and for the further 2 years is 350. So there are two different payments for the two different blocks. The annual lease payments will increase, and we are also given that what has been the CPI index on January 21. So there has been some changes which have occurred on after how many years? I think 18, 19, 20. After 3 years, there has been a change in index. The borrowing rates are given 8%, 10% on two different dates at the inception 18 and 21. Now, at the commencement date, the company, the lessee, did not think that it's a viable option to renew. But in the quarter of 21, he made some major changes and now he feels that we should go for renewal. Jacob determined that it would recover the cost of improvements only if he extends and goes in for a renewal option. Now he says whether a remeasurement of the lease is required in the first quarter of 21. Now, I want your inputs in this particular case. What do you think we should do in this case? Are we supposed to make some reworkings at this particular stage? Are we supposed to make some recomputations? I think I can come back to the board now to solve it back, I guess. By the way, first of all, the quick question what comes to the mind is this a case of a modification or is this a case of a reassessment? Because the accounting treatment when it is a case of a reassessment is different and the accounting treatment when it is a modification is different. So the first question is this a modification or is this supposed to be a case of a reassessment? Let's get the quick question first. And I get the answer that it is supposed to be a modification. I don't think so, that it is a case of a modification. I think it's a case of a reassessment. This is one area where people tend to get confused. So let me give you some food for thought at this particular stage. When you look at the concept of a reassessment and a modification, the main crucial point of thought which should come to the mind is it supposed to be a one-sided decision or is it supposed to be, a decision which is mutual? When you look at the case that it is a modification, it is supposed to be a mutual agreement. The lessor and the lessee sit down together and they mutually agree that, okay, we're ready to make this change. Then it would be considered as modification in nature. But if it is supposed to be, what I tell people is a one-sided affair, that as a lessee, you take a call that I want to now change the lease term, it would become a case of a reassessment. And it is important to filter whether it is a case of a reassessment or a modification because the accounting treatment in this case will vary. This is a case of a reassessment. Now, let's, I think, work this out. So in this particular case, I think what we need to do is a couple of workings. So I'll just quickly share some workings as well. A scope increase could also be a case of modification as well. So we can't really say that. Just give me a second. I just need to organize some workings also. Just give me a minute. The name of the question, I think, is Jacob. Yes, Jacob. I'll just take the quick workings as well so that we don't have to work too much. That is December 21. Okay, I think I could not get the inputs. You'll have to do perhaps the workings for me. Okay, so I think let's start working on the data. So that was question number 9. So let's work the data. We are given question number 9. Right, so I think first we need to work on the details. I would have done the things easy. Or let me do one thing, because this will involve a lot of computations. I can do a similar question maybe if you want. Would that be good to go? Because otherwise we'll have to do a lot of workings. I can't get my workings at this stage. So can I take a similar question and leave this to you for a practice? I'll just share another question to you. Just give me a second. No, I think I got this. No, we can do this question only. I opened the wrong file, I think. Yes, I've got the data. Okay, so I think I have the data with me, not an issue. So we'll start working on this. So at the first instance, what we need to consider is the initial term of the lease is supposed to be 6 years and renewable option is there. But I guess we are not given any incentive. It says initially there was no incentive. So let's begin with the lease term. Initially, as per the instructions which are given in the question, it is very clear that it was not certain that you would exercise the option. So lease term is going to be 6 years. No reasonable certainty to renew the lease. So at the inception, it is very clearly given that there was no certainty to extend the lease. So it becomes a period of 6 years. So we need to first of all work out the figures at the inception. So let's see what is the data on initial recognition. So I think first what I need to do, I need to calculate the present value of lease liability. Now we also need to see that when are the payments being made in this particular case. So I guess the lease payments are made, I guess, at the beginning of each year. I'm considering the payments are made at the start of each date. So we need to consider the present value lease payments. And this is going to be, the payment is 2,80,000. We're going to consider a present value interest factor annuity for a period of 1 to 5 years, because first payment is made at the very inception. So there are only 5 more payments to go. And this will be discounted at the rate of 8%. So I think I'll give you the discounting factor. It is 3.993. So the present value of lease liabilities will come to 11,18,040. So this is the value at which the lease liability will be recorded at the inception. So let me also have a look at the entry at the inception. So the entry which will be done at the inception is ROU asset gets a debit, lease liability gets a credit, and the bank gets a credit for the first payment made. The lease liability is 11,18,040. 2,80,000 is the payment made. So the asset will be recorded at the total figure. So this is going to be 11,18,040 plus this. This is 13,98,040. So this is the accounting which will be done at the very inception. Since the payments are paid at the beginning of each year, the asset will be a sum total of all the payments, but liability is only the payments which are yet to be made. So we have taken a payment of 5 years discounted at the incremental borrowing rate, which is 8%. Now, once we have done this, now what we need to do, 3 years have already passed. So what you need to do, you need to make a leisure account for the lease liability or amortization chart, whatever you prefer. Asset and liability needs to be, accounted for the next 3 years. So let's look at the accounting for the next 3 years to go. So I think I'll start with my leisure account for the next year, 3 years for the lease liability. So let's have a look at how the lease liability will be accounted. So we post this entry which is done at the inception. The ROU asset was recorded at 11,18,040. Let's calculate the finance charge on this. So finance charge will be taken at the rate of 8% on this. So 11,18,040, 8% interest on this would be 894. It is 89,443. That becomes the finance charge. Now, no payments are made at the end of this year because we're making payments at the beginning of each year. So we get the balance CD as a balancing figure, which will become the opening balance next year. So 11,18,040 plus 89,443. This comes to 12,07,483. 12,07,483. Again, we consider the interest on this at the rate of 8%. So let's take the finance charge again at the rate of 8% on this. That's 96,599 rounded off. And sorry, the interest in this case goes wrong. Sorry, we need to first pay the rental. So we first pay the rental at the beginning of the year, that is 2,80,000. So interest will be taken on this balance now. Whatever is the net balance, we take 8% interest on the net balance. So 12,07,483 minus 2,80,000, 8% on this would be 74,199 approximately. So you made the payment at the beginning of this year itself, and then we take the interest on the net figure. So let's take the balance CD again as a balancing figure. So before we make the changes, we need to make the leisure account up to the end of the third year. So this is 12,07,483, 74,199 minus 280. This is 100,1682. This becomes the balance in the next year as well. This is balance BD 100,1682. And again, before we take the interest, we need to make the payment as well. So we made a payment of 2,80,000. And again, we take the interest on this net figure again. So let's take the finance charge at the rate of 8% on the net balance. So 8% interest comes to 57735. 57735. So we can get the balance CD as a balancing figure again. 1001682 57735. This comes to 779. This is 779417. That is the balance CD. Okay, so I think we reached the point where we made the ledger account for the lease liability up to the date when the index underwent a change. Same thing you need to do for the ROU asset as well. So the first thing is to reach the point when the index undergoes a change. Do the normal accounting up to the date when the index changes. Now for the asset value, I think I'll just directly pick up the data. So my asset value was recorded at 1398,040, and we need to spread this depreciation over a period of 6 years. So we can get the annual depreciation. So we can spread this amount over a period of 6 years. That is 1398,040 divided by 6 years. The annual depreciation is 233,007. So we can get the book value after 3 years. So let's get the status of the book value. So 233,007 for 3 years. This works out, I think, at 699,019. That is the book value. So this is the book value of the asset. So I think we've got the two datas very clear now. Okay. So I think this part is done. This is usual accounting what we've done. So I think before you take care of the change in index, you just need to do the usual accounting. We made the ledger account for the liability for 3 years. We made the asset account. I didn't make the ledger account, but just directly got the values. Now, moving further with this, let's organize the data. So we've got now the ROU asset from the previous working, and we've got the lease liability from the previous working, and then we'll go for the change in the index. So this is 779417, 779417, and this is 699019, 699019. Okay, now there has been a change in the index. Now, due to the change in index, what do you need to do? I always tell people that you now need to consider what is called RRR. You need to consider the revised payments with the remainder period, and you need to consider the revised discount rate as well. So in this particular case, let's, I think, organize the data once again. So once the change is made in the index, now what we need to consider, I think first let me just pinpoint one thing which you need to keep track of. There is a change in index, you need to consider RRR. That's the key point. Now, what is that RRR? You need to consider the revised payments. That is one focus. Because of reassessment, the other focus is we need to consider the revised discount rate, and we need to consider the remainder period as well. So this is the key focus when a reassessment is done, that you need to apply the concept of RRR. You consider the revised payments, remainder period, and the revised discount rate. So which we need to do some workings now. So I think let me just come back on the workings again out here. So let's see the workings for the remaining period. I think now since we're going to extend the period as well, the tenure is going to be 4th year. The tenure in this case is supposed to be 4th year, 5th year, 6th year, 7th year, 8th year. Earlier the lease was supposed to be 6 years, so this was the original period. Now we're going to extend it. Now we're going to extend this further, so it is going to be extended to the 7th and the 8th year as well. So let's organize the figures now. What will be the inputs? Now remember that when you are looking in terms of the calculations of the lease payment, you need to be careful. The payment was supposed to be 2 lakh 80 for the first 6 years, then it underwent a change. So we need to accordingly make them proportionate. So if you see the index, I think if I just show the question once again on the screen, if I just go back again on the screen, we can see the annual payments are 2 lakh 80,000 for the initial term, and it is 3 lakh 50 for the next 2 years, and the index has undergone a change from 250 to 260. So let's do the workings. So if I go to the workings now at this stage, this is going to be 2 lakh 80. The index became 260 instead of 250. So this becomes 291 200. So in this particular case, the working is 2 lakh 80,000 is based on an index of 250. The index has undergone a change to the extent of 260. So you get the revised payment. And this would remain the same for the next 2 years also. But then 7th and 8th year is going to undergo a change. It was 3 lakh 50. It was supposed to be 3 lakh 50. So this has to undergo a change to 364. Let's also show the workings of 364. The payment was 3 lakh 50 based on the index of 250. The index underwent a change to 260. So make it pro rata. And once you consider the present value interest factor, you need to consider the revised rate as well. Now, you can see something very clearly, which I want to pinpoint at this particular stage. So one thing which we can see very clear, I have taken the revised payments, focus 1. I have taken the revised discount rate, focus 2, 10%, and we've taken the remainder period, including the change in terms of the lease term. So your focus needs to be very clear that you need to consider RRR, revised rate, remainder period, and the revised discount rate. I think I'm just going to give you directly the present value of all these computations. So once you discount all this at the rate of 10%, let's directly give you the figure. We don't want to do the computations. It is going to come to a total of 13 lakh 18,000. This comes to 13 lakh 18,000 and 408. This is coming to 13 lakh 18,408. This is the value of the new lease liability which is to be done. Okay, I think now we are basically done. Once this assessment is done, now you need to compare this value. You need to compare this value with the current book value. This is what the new liability is going to be. Compare the two. So this is the increase in the liability, and this will be adjusted against the ROU asset itself. So whatever is the change, the difference gets adjusted in the asset value. So 13 lakh 18,408 minus 779,417. So there is an increase to the extent of 538,991. So you put the entry ROU asset gets a debit and the lease liability gets a credit, and this entry is done with the same figure itself. Wow. So I think let me just quickly connect the dots to you. When it becomes a case of a reassessment, the filter which you need to think is reassessment or modification is if it is supposed to be a mutual change, it is considered to be a modification. That means both the parties sit together and they mutually agree to a particular consensus. That is a case of modification. That's a different accounting. But once it is a change which is made by the lessee purely decides on his own without any mutual consent, it is a case of reassessment. In terms of reassessment, what you need to basically do is you need to get the book value of the liability. Though getting the book value of the asset is not important, but you need to get the book value of the liability. Now, why did we compute the book value of the asset? The reason is that if there is a decrease in the value of the liability, you need to adjust it against the asset value. And in that particular case, you need to be sure that if the value of the asset in the books is already lesser than the decrease in the liability, then it is dangerous. So on a safe side, you need to calculate the book value of the asset, though technically if there is going to be increase in liability, the value of the ROU asset is technically not required. Then you can simply calculate the liability, just get the book value of the existing liability. Once you know that there has been some reassessment and change, now consider the concept of RRR, remainder period, revised discount rate, and the revised payments, and you get the present value of that liability. You compare the existing book value and the revised value. Whatever is the change gets adjusted in the ROU asset in that case. Increase or decrease, whatever gets adjusted. This is reassessment. Right, friends? I hope you got the dots connected. Okay, I think now it's time to give you a small little break as well. And then I think after this, we will do questions on modifications with you. The reassessment part is done. Let's do questions on modifications and on the special issues. So far so good. I think 10 minutes break. I hope everybody is able to catch up with the points so far. It's a very good question. Yes, more wonderful questions coming after the break. So let's give you a 10 minutes quick break. Then we join back, friends. Enjoy your break. Haji, thank you. Haji, we can start. We can start, I guess. Welcome back, friends. So I hope you had a relaxation of mind. I think somebody is asking me the questions which we did on 115, the solutions. Yes, I think the slide solution which I was working in, I think I'll just upload that immediately after the class today as well, because I think I uploaded one particular one which was used on the board. So no worry. The solution slide which we're working on, I'll share that as well. No worries on that. Okay, so I think let's take the journey forward. So we have done one question on the concept of reassessment. I think we need to do one question on the concept of modification as well. So I think let's do a little complicated question on a modification. What do you say? Directly go to something which is slightly more complicated, or you want to do one easier and then one tougher question on the same? So one easy, one tough, or directly take you to something interesting indeed? Your choice. Okay, then I think let's take a risk. Time is the essence. So I think I am going to take you to, I'll just share that question on the screen only. So let's have a look at, okay, let's have a look at this particular question number 11, and let's read the inputs which are given. It says lessee enters into a 10-year lease. So I think let's note down the facts. It enters into a 10-year lease. It says for a 5,000 square feet meters of office space, the annual payments are 1 lakh, which is payable at the end of each year. The interest rate in the implicit lease cannot be easily determined. Therefore, the lessee's incremental borrowing rate is given at the rate of 6% per annum. Then it says at the beginning of the 7th year, it says lessee and lessor agree to amend the original lease. Now, I think quick question to you. Is this a reassessment or is this a modification? So, it is very clearly given that at the beginning of 7th year, lessor and lessee agree to amend. Can I say once it is a mutual change, it is undoubtedly considered as a modification. I think that's important to identify, as I said earlier, that if it is supposed to be a one-sided change, the change is made by the lessee only. In the previous question, we saw the change was made with the lessee, but in this case, it's a mutual change. It says by extending the contractual lease term by a period of 4 years. So in this particular case, they have increased the tenure of the lease by 4 years. The annual lease payments are unchanged. That is 1 lakh payable at the end of each year from 7th to the 14th year. The incremental borrowing rate is given to us at the rate of 7%. How would the said modification be accounted for? Okay, so can anybody like to give me what will be the accounting? So would you like to share your thought process in terms of how the accounting in this particular case will take place? Let's get your insights on that. Quite similar to the computations which we did, but would you like to share some thoughts how the accounting in this case will be done? I'll just, in the meantime, just still expand the question on the screen. That was question 11, what we just read. So any inputs? What do you think? How would we do this particular accounting? It's a MTP question. Okay, I'm yet to get some inputs on that. Generally my experience has been that, modification is one area where people, deter from the calculations. Okay, I think let's begin. I think irrespective whether it is a case of a reassessment or modification, the first thing you need to do is, of course, calculate the value of the asset liability on the date when the reassessment or the date when the modification is done. So I think let's begin with the first initial data. So looking at question 11, let's go in for the initial measurement of the asset and liability. So I think in this particular case, the rentals are payable 1 lakh at the end of each year with the incremental rate 6% per annum. So I think let me just organize the data. So we can say we can calculate the present value of lease liability, and this is going to be discounting 1 lakh, and we need the PVIFA. Can I say this is going to be discounted at the implicit interest rate that is 6%? And what is the tenure? The tenure of the lease is supposed to be a total of, I guess, 10 years, right? So the lease is for a period of 10 years. So let's take a 10 years cumulative factor. I think I'll already give you the data. So I think if I look at the present value factor, it is 7.36. So this is coming to 7.3600. So this is going to be 1 lakh into 7.36. So that works out at 7,36,000. That is the present value of the lease liability. And can I say, as far as the ROU asset is concerned, that would be also of the same figure itself. There is no initial payments, unlike the previous question. So the asset and liability would stand at the same figure on this particular date. Okay, now quick question to you, though I think nobody gave me some inputs in this case, but I think let me put a quick question to you at this particular stage. My question right now is that in this particular case, do we really need to work out the ROU asset value on the date of modification, or the lease liability calculation itself is enough? Because what is happening in this particular case is the change in the lease term, and due to the change in the lease term, there will definitely be an increase in the lease liability. So considering that there is going to be increase in the lease liability, do you think there is any point in calculating ROU asset value, or can we skip that? We have to modify modification date on the ROU asset, that's right. But in any case, do we need the book value of the asset on the date of modification? I would say no. Because in this case, we know that the tenure change would mean increase in the lease liability, and that increase will in any case increase the asset value. So I think we can safely just calculate the lease liability calculation. So I think what we need to do, make a quick leisure. So let's make a quick leisure of the lease liability up to the date of modification. So I always prefer to make a ledger account instead of an amortization chart, because that makes the calculations a little more easier. So when did we make a change in the tenure of the lease? It says at the beginning of 7th year. So how many years ledger are you going to prepare at this stage? Can I say 6 years? So let's begin. ROU asset gets a debit. This is 7,36,000. We take the finance charge at the rate of 6%. So interest at the rate of 6% is 44,160. We make the payment, that is to the extent of 1 lakh. Get the balance CD as a balancing figure. Repeat this exercise for a period of 6 years. So though on the calculator you can do it faster as well. You know what you can do? Multiply this 1.06 minus 1 lakh, then 1.06 into 1 lakh. You want me to do some faster Rajnikant style calculations, or make the ledger for 6 years? Otherwise, the shortcut is into 1.06 minus 1 lakh, into 1.06 minus 1 lakh, and do it faster. Okay, we can do that. Okay, so let me, I think, give you the book value of this liability at the end of 6th year. This is 6th year end. So work out the calculation. This is 736 into 1.06 minus 1 lakh once, twice, thrice, 4, 5. I think this is coming to a total of 346. This is coming to 346, 499 shortcut. I hope that works. ROE asset, of course, we don't need, but this is correct. So what I've done on a shortcut is I've taken 736 into 1.06 minus 1 lakh, and then whatever figure you get, again into 1.06 minus 1 lakh, and so on, and I got the shortcut. Of course, you can't do this in the exam. We're doing it for the matter of convenience at this stage. Don't do this in the exam, but to cross-check your results, you can of course do that. Okay, so this is done. This is, the first stage where you calculate the value of the liability. I'm not taking the value of asset. You can on a safe side, but I've taken the book value of the lease liability. Now we go further. So now what we need to do is on the date of modification, we need to work out the lease liability in this particular case. So tell me now, am I supposed to apply in this particular case again the concept of RRR? Do I consider the revised payments at the revised discount rate for the remainder period and get the results of the revised value of liability? Yes, of course. So we're again going to apply the concept of RRR, remainder period, revised payments, and the revised discount rates as well. So in this particular case, I guess if I go back to the question, he's given me that we have extended the leave by another 4 years and the annual payments are still the same. So there is no change in the payment, but there is a change in the tenure and the new rate is at the rate of 7%. So how many years are there now? So we need to consider 1 lakh into the present value interest factor annuity. So we need 7% new factor. How many years do we need to consider now? The total tenure was 10 years, out of which 6 years have already passed. So 4 years out of the original term was pending, and we extended the lease by another 4 years. That makes it a total of 8 years. 4 years out of the remaining original lease, and that's right, 8 years. So I think if I give you the cumulative factor, it is 5.9713. 5.9713 is the cumulative factor. So based on this, this comes to 597,130. This is the new value of the liability. Now compare this with the book value of the liability. So if I consider the book value of the lease liability at the end of 6th year, what we computed, that is to the extent of 346,499. 346,499. So there is an increase in the liability which is to be adjusted against the asset value. So 597,130 minus 346,499. This is 256,31. Well, as of now, you would realize that the accounting, what we have done in terms of the reassessment as well as the modification is same, because in this particular case, there has been an increase in the scope of the lease. But if it is going to be different parameters, the accounting could undergo a change. So the entry for this is going to be ROU asset gets a debit, increase the asset value, and the lease liability gets a credit. So this will be the entry which will be done at the date of modification. I think that was pretty simple and straight indeed. Okay, now I think let's do a little more complicated case with you. So let me share the question back on the screen. Yes, that's a good question. Now let's have a look at the question number 12. And this is again a case of modification. As we'll read, we'll come to know. But this is with regard to reduction in the space. Now this becomes interesting. It says lessee enters into a 10-year lease for 5,000 square feet of office space. The annual payments are made at the end of each year. The interest rate implicit cannot be easily determined. So therefore, the incremental borrowing rate is 6% at the beginning of 6th year as good as in the 5th year, the lessee and lessor agree to amend the original lease. It's a mutual change, so it indicates a modification again. It says to reduce the space to only 2,500 square meters of original space starting from the end of the first quarter of year 6. The annual lease payments are now going to be 30,000 and the incremental borrowing rate is also going to change. How how would the above modification be accounted for? This is a case where the space is undergoing a change. Now, when the space undergoes a change, then I think say that I don't know whether I'm going to get the answer from your side, but I think let me share the inputs and you can maybe vouch me on that particular part. So can I say if the space reduction takes place, there will be a reduction in the asset and the liability value. But are you going to make a reduction in the asset liability value exactly equal to the percentage space reduction? Like for example, in this particular case, the space is got reduced to 50%. So am I going to change both the asset and liability equal to 50% in this particular case? That is the question. Because you have the value of asset and liability for 5,000 square feet space, and once the space gets reduced to 2,500 square feet, so am I going to consider the book value on the date of modification and make asset liability 50-50, or is there something else which needs to be done? What do you say? So are we supposed to make a equal reduction? That means reduce the asset by 50, reduce the liability by 50, or are we supposed to do something else in this particular case? We cannot do so. That's what the input I get. Okay, so let me tell you, in terms of the change in the lease space, that's what we are exactly going to do. Our solution is going to be worked upon two different parts. One is on the reduction of space, reducing the asset liability to the extent of 50% and the gain or loss recognized in the P&L. Second stage will be the recomputation of the lease liability based on the concept of RRR. So remember, in this particular case, in the previous example, there was an increase in the scope. So it was simply, calculating the revised liability, comparing it to the book value, and getting recorded the change. But in this particular case, when you're looking at a decrease in the scope of the lease, in this case, changing the lease, you can say space, we need to first of all bring down the asset liability because of the reduction in space. Second, what we need to do, we need to account for the change in the lease liability. So we're going to work the solutions in two parts. Let's begin. So we're looking at the question number 12. Just let me expand this on the screen. So this is a case of a change in the space. Let's work this out. Question number 12. So here we're looking at a reduction in space. It is undoubtedly a case of modification, but a reduction in terms of space. So let's work out, first of all, the inputs in terms of the initial recognition. Now, in this particular case, the question rises, am I supposed to work out the ROU asset value also? Yes. Unlike the previous cases where the asset value was not required technically, because you just need to make the changes in the lease liability, adjust the asset value. Here we need a reduction in the asset value and the liability. So you need to work out the book values of both of them. So let's first consider the present value of lease payments. So let's see the present value of the lease payments. So if I go back, where did the question go? Oh my God, the question got disappeared. Okay. Anyway, so I think let me just take the data. So the lease tenure was supposed to be 10 years and the payment was supposed to be 50,000. So let's take the payment of 50,000 into PVIFA, which is for a period of 10 years. So this is 6% for a period of 10 years to get the original value of the liability. So in this particular case, the factor is 7.36 again. So 50,000 into 7.36, that works out at 3,68,000. The payments are made at the end of each year. So you can comfortably take this as 368. And can I say even the value of the ROU asset would be same on the initial recognition, of course. So that also works out at 368. You want me to work out the book values of the liability and assets quick way without making ledgers? Same style, into 1.06 minus 50,000, get the figures on the data modification, right? I think the answer is already given to me. Wow. So let me just work this out. When did we make the change? It was at the end of the 5th year. So let's do some calculations. Let's get the book value at the 5th year end. So we need the lease liability. We just quickly work this out. 368 into 1.05 minus 50. Once, twice, 3 times, 4 times. I took it 5%, I think. So 6% once, twice, thrice, 4, 5 is coming to 210,613. This is coming to 210,613. Just check this again. This is 368 into 1.06. 1, 2, 3, 4, 5. Yes, it is 210,613 or almost 612. So this is the book value of lease liability, and then we can also get the value as well. And that will become 50%, 10 years life, just make it half. So I think this will be 184. This is the first calculations which you need to make, that what is the book value of the asset liability. And if you're in a trouble in terms of deciding whether we need the value of the ROU asset or not, just calculate it. What's the big deal? So I think it's a better deal to do it, instead of filtering that do we need a liability and an asset value both, calculate both of them. What's the big deal? Because calculating asset value in any case will not take much time. Now considering the inputs, that there has been a reduction in space which is exactly equal to 50%. So what we need to do in this particular case, because of 50% decrease in space, you need to bring down the asset and liability proportionately down. We're yet to work about the concept of change in the liability. That would be a next stage. So in this particular case, we can say the entry which you can pass is lease liability gets a debit, ROU asset gets a credit, and any balancing figure in this case will be a gain or loss in the P&L. So lease liability will be reduced exactly half. That is 105, 306. And the asset will also get reduced to half, that is 92. So there is a balancing figure which is a gain, and that gain is going to be taken in the profit and loss account. So let's see what is the difference. 105, 306 minus 92. The balancing figure is 13,306. That is the gain on account of reduction in the space. Wow. Now the question is not complete. There is a second stage of accounting which needs to be done. We now need to consider the calculation of the revised value of liability using RRR. So let's go ahead. So in this particular case, now we need to calculate the new lease liability. And this is going to be based on, again, RRR, revised payment, revised discount rates, and we're also going to consider the remainder period as well. So we need to see what is the new payments now. I think the new payment is 30,000. And we need a PVIFA, which is going to be at the revised rate. The revised rate now is standing at 5%. and the tenure which is left over is another 5 years. So we take a cumulative factor 5% for a period of 5 years. So I got 50% reduction works out. Instead, we compute the lease liability for the remainder period and adjust it. Yes. I would say the better picture is that if there is a reduction in space, leave the new rental aside. Don't get into that. You get the value of the asset liability, make a reduction, get the gain loss, and then go in for our concept. It becomes easier. So I guess if I take the cumulative factor, it is 4.3295. So 4.3295 into 30,000, that works out at 129,885. That is the new liability with us. Now we need to compare this with the book value to put the entry. So we can compare this with what is the existing book value of lease liability, what we have computed post the reduction. That's, I think, to the extent of 92. No, it was not 92. That was asset. This is 105,306. 105,306. So there is an increase in the value of the liability, which can be adjusted against the asset value. So 105,306, this is 24,579. So the entry for this is going to be ROU asset gets a debit and the lease liability gets a credit. This gets adjusted. Wow. So I think this takes care of another modifications as well. Okay, so I think I have covered two cases, though there can be blended kind of case as well. But I think let me just quickly give you a mind map at this particular stage, so that we are clear in terms of reassessment modifications when the scope went up and the scope went down. Just a quick recap on things. Let me just make a mind map here. So let's make a quick mind map on the third block as well. So I'm looking at reassessment. We did a question on reassessment and the concept of a modification, where I did some specific situations on the reassessment and the modification part. So when it comes to reassessment or modification, you need to first of all understand that this is a mutual change. This is supposed to be a mutual change. And when you say a reassessment, it is basically decided by lessee only. It is basically decided by lessee. The lessee decides what he wants to do. That is supposed to be more, you can say, a one-sided kind of change. That is like a two-sided change. Both the parties mutually agree to make a change. Now, when you see the concept of a reassessment or modification, let's see the accounting. So I'm looking at, first of all, the concept of a reassessment. How would the accounting get done? And we're looking at the concept of modifications. How would the accounting get done? So if you look at the concept of a reassessment, we can say you need to get the book value of lease liability and ROU asset on the safe side. So you need to get the book value of lease liability and ROU asset on the date of change. You need to bring it on the date of change. Though technically speaking, as I said earlier, you don't need to calculate the book value of the asset technically. If you're pretty confident that the value of the liability will push up, asset value technically not required. So I'll just make a quick mention that when you're looking at the lease liability, we can say this is basically required. This is only information technically required. So in this particular case, we can say this is the information which is technically required. You don't need the value of asset unless the value of the liability will go down. You don't need to concentrate on the asset value. Just get the book value of the liability. That is one. Then second, what you need to do in this particular case is you need to get the revised book value. You need to get the revised book value of lease liability again. And this will be using the concept of RRR. You need to consider the concept of remainder period, revised discount rate, as well as the revised payments, and do this. Now, let me also caution you that there is a case where we do consider the case of RRO as well, and original discount rates are also taken. So we need to be careful on that particular part. So there are cases, where we land up considering a original rate as well. But generally, invariably, it would be a revised rate. And then what you need to do, you need to compare the two. So at the third stage, you take the difference, and the difference is adjusted against ROU asset. The difference is adjusted against the right of use asset in this particular case. So whatever is difference will get adjusted in the asset value itself. So this is what we did in one of the questions on the reassessment. Okay, and you said lessee has to do reassessment for each reporting date. No. It is okay, reassessment in the sense, if the lessee chooses to make some changes on his own, like for example, we saw the case of extending the lease term, which he decided, I want to make a change. Now you can see something interesting. The tenure of the lease undergoes a change, can be modification. The tenure of the lease changes can be a reassessment. If you have witnessed in the two questions, when there is a change in the lease term, it can be reassessment, it can be a case of modification. In the example which we did earlier, the change in the lease term was reassessment because the lessee decided, I am taking the option to extend the lease. It was not a mutual change, it was a one-sided change, which was considered to be a reassessment. But then the change in the lease term can also be, a case of mutual thing. They sit down together and amend the lease. So many people get confused on the fact that a change in a lease term is a modification. Not necessarily so. It all depends upon that whether the change is mutually done by both sitting together, or it's a change which the lessee makes on his own without the lessor's intervention. And accordingly, it becomes a reassessment or a modification. Okay, now coming to the concept of modifications, we did basically two areas of discussions with you. One is we did the case where you can say it was increase in the scope. And when I did the concept of increase in scope, we did the lease term going up. That was one case we did. The second one we did was a decrease in scope. And when we did the case of decrease in scope, we did a specific case where the space was reduced. The space was decreased. Now this is, we've done some specific kind of questions on the concept of modifications. So we did a case where the scope went up and there was a lease term change, the scope went down and there was a space reduction. Different parameters could change the way the accounting is done as well. Now, in this particular case, when you saw that there is increase in lease term, we very clearly knew that lease liability will definitely go up. So there was no need to calculate the book value of the asset. So in this case, what you can do, only three steps. You calculate the book value of the lease liability on the date of change. You calculate the revised value of lease liability. You calculate the revised lease liability using the concept of RRR. It's exactly the same accounting as a reassessment. And then you take the difference. And the difference is adjusted against the ROU asset in this particular case. So you can go systematically on three steps again. Calculate the book value of the liability and then calculate the revised value, consider the differences to be adjusted. Then when it came to the change in the space reduction, what we did in this particular case, we first of all calculate the book value of the asset as well as the liability on the date of change. Then what we did in this particular case, we made a pro rata reduction. We made a pro rata decrease in this case. The asset was also decreased 50%. The liability was also decreased 50% only because there was a change in terms of the space. And therefore we made a pro rata change. And then we recognize the gain or loss. We recognize the gain or loss. So first we took the book value, we took a pro rata reduction. By comparing, we got the gain loss. The reduction in the asset liability was captured and the gain and loss is taken. Then again, you need to repeat these three steps again. Then you need to repeat these three steps again. So we need to repeat the three steps again all out here. That means you got to consider the book value of the liability after the reduction, then get the revised liability based on RRR, compare the two and get the asset value. So you need to consider 3 plus 3, 6 steps in this case. Go carefully because you need to first of all capture the reductions and get the gain loss under 3 steps, and then you need to capture the change in the liability, again the 3 steps, exactly what we did. Things can become more complicated when blended together. A combination of changes occur that can be complicated, but we're not getting into all that. Right, friends, I hope this mind map now helps. This is a capture in terms of reassessment and modifications, but as I said, a few selected cases only. It is not covering the ambit of all the kinds of modifications or reassessment, to be very fair. So far, so good, I guess. Ready now to go to the block number 4, where I think my main concern is, of course, on the sale and the leaseback transactions. I believe many people, many students get problems when they do the questions on sale and leaseback. I'm going to do 2 questions with you and make your life simple. You're going to do those questions in just 5 minutes, trust me. Do you get troubles in terms of doing questions on sale and leaseback transactions? Do you get any problems when you do questions on a sale and leaseback? No? So I am carrying a very interesting question at this stage, which is on a sale and leaseback to you. No? Then I think let's do this question. So this is on a sale and leaseback. So let me just read the question. I'm going to do 2 questions on this area. One is the easier one. One is slightly, which is containing a little more technical part. We'll do that part as well. Let's, I think, read. I hope this question is fairly visible, right? This question not seen by me. That's why I've taken a new question for all of you. The next 2 questions which I'm going to take is something which you have not done earlier. It says on January X1, painting sells an item of machinery to college at a fair value. It says it is sold at a fair value. The asset has got a carrying amount of 1.2 million prior to the sale. The sales represents the satisfaction of a performance obligation in accordance with Ind AS 115. Painting enters into a contract with college for the right to use the asset for the next 5 years. The annual payments of 5 lakhs are made at the end of each year. The interest implicit in the lease is 10%. The present value of annual lease payments is 1.9 million, and the remaining life of the machine is much greater than the lease term. Your expired explain how the transaction will be accounted on January X1 in the books of painting and college. I think my focus is more in the books of the painting, that is seller lessee. Now I'm going to give you the trick. I don't know if it matches with your trick or not, but you can vouch me later. But I'm going to first explain the trick to you, how you can organize the entry. I think first of all, we can see that it is a clear-cut case of a sale made, and then it also says that they entered into a lease transaction as well. So there is a sale and there is a lease back. So I would say the first thing you should do is, there is painting and there is college. He made a sale and he made a lease back. Now watch the data carefully. I'm going to make your life simple. Then I'm going to get your inputs, whether this technique is what you follow or not. Do let me know after I'm done. So first of all, we can see that the sale is made at a fair value, which is to the extent of 3 million. And the present value of the lease payment is to the extent of 1.9 million. The first thing I do, I consider the present value of lease payment as a percentage of fair value. The first thing I always do, I take this 1.9 as a percentage of 3 million and get the percentage. Now this is 1.9 divided by 3, it comes to 63.33%. Now we need to understand a basic common sense that first I made a sale, I got the money. Then there is a lease back, I return the money. So you can say that out of 3 million, 1.9 million is being returned back. It's like a loan. It's like a lease. So this portion is the loan, or you can say this is the lease, because finance lease is nothing but a loan. And then you can consider the remaining percentage, 100 minus, that comes to 36.67%. That is supposed to be the sale. It's, I always say, a partial sale and a partial loan. A sale and lease back is always considered a partial sale and a partial loan. So when you consider the present value of lease payments on the fair value, you get the portion which is the lease. And the remaining portion is what is the sale. Now you need to put an entry which is blended together, sale and lease put together. So what is the entry for sale? The entry for the sale of the asset is bank gets a debit, asset gets a credit, and the profit on sale goes in the P&L. So this is the entry as far as the sale is concerned. Bank gets a debit, asset gets a credit, and the profit goes in the P&L. Then you need to merge with this the entry for a lease, and the entry for the lease is ROU asset gets a debit and the lease liability gets a credit. So put a consolidated journal entry in this case. Once you put the consolidated journal entry in this case, now we can map the dots. So what is the figure of bank? We received a total of 3 million. When you made a sale, that is the bank figure. The asset is got a carrying value which is 1.2 million. So this is recorded at the book value. Now we are not going to record the profit on sale to the extent of 1.8. No, because it's not 100% sale. So when you're going to record the profit on sale, the profit on sale is the total profit is 1.8, but since the sale is to the extent of 36.67%, we're going to record the profit to the extent of 36.67% because it's a partial sale. So if I take the profit on sale 1.8 into 36.67, it comes to 0.66. Now, as far as the lease liability is concerned, it is already given, it's 1.9 million. If you want, you can take the ROU asset as a balancing figure. Otherwise, what you can do, you can compute this figure as well. And how do you compute this particular figure? You are retaining the asset because of the lease. The book value of the asset is 1.2. And the lease is to the extent of 63.33%. So out of 1.2, you retain 63.33, that comes to 0.76. And I think now if you see the debits and the credits, I think the debits and the credits in this case is exactly matched. I am now very keenly interested to know, is this the way you tackle the sale and lease back transaction? The nation wants to know. I'm more keen to know this. I just took the percentages, and based on the percentages, I set my entries in this case. Yeah, the answers are correct, but I just want to know that this is the way do you do a sale and lease back transaction, organizing the data in terms of the percentages and then putting the journal entries. I do like this. That's great indeed. Okay, let's do another question with you on this area with a slight little difference. The question is exactly same, but it has got a slight little difference in terms of one particular input. And then I think this other cases is simple. Sublease and all is easy. So I think I wanted to take up the core areas. At least we've taken the major core areas in the standard. Now let's look at the question number 16 with you. It says on January X1, M sells an item of machinery. It says to C for 3 million and the fair value is 2.8 million. So it is sold at 3 million, but the fair value is 3 million. So it is sold at an excess of 0.2 million. It is sold at an excess of 0.2 million. The sale is more than the fair value. And when the sale is more than the fair value, I think we need to tackle that excess. We'll see how do we tackle that excess, no worry. The carrying amount is the same and it is supposed to be meeting the Ind AS 115 requirement. Then he says it entered into the agreement for the right to use the asset for the next 5 years. Annual payments are due at the end of each year. The present value of lease payments is given. The rest of the data is exactly same. But the only thing is that the sale is made more than the fair value. Now, my advice, when the sale is made more than the fair value, you can, just keep that excess out. Let's see. So what I'm going to do in this particular case, we know that there is M and C. So there is a sale which is made and then there is a lease back which is done. So let's remove the excess. So from the sale proceeds of 3 million, remove that 0.2, it comes to 2.8 and then start doing the question. From the present value of lease payments also, remove that 0.2 and then start doing the question. Consider as if that 0.2 million is thrown out of the question and don't even look at that 0.2 for the time being, and let's do the entry. So first, what you can do, you can put the entry for that excess. That excess is undoubtedly a loan. So you can create a financial liability to the extent of that excess that is 0.2 million. So the first thing you should do is remove that excess out. So whatever is that 0.2 excess, throw it out at the very inception. That excess is nothing but it is a loan. Now, we're going to consider the percentages 1.7 divided by 2.8. We're not going to consider 1.9 by 3. We're going to consider 1.7 divided by 2.8. It comes to 60.71%. Is that a lease or is that a sale? So is that a lease or is that going to be a sale in this particular case? Can I say this is going to be a lease because this is the money which is like a loan, and the remaining percentage, that is the remaining 39.29%, that is going to be, you can say, a sale. So partial sale and a partial loan once again in this case. So now we can do the entries. Let's first set the entry and then start putting in the values. So in this particular case, let's first fit in the entry. The entry is going to be bank gets a debit, the asset gets a credit, and the profit on sale goes in the P&L. And then for the liability, for the lease, ROU asset gets a debit and the lease liability gets a credit. Organize the entry and then you can start fitting in the amounts as well. Let's have a look at the figures now in this case. Now remember, the bank is going to be taken for 2.8 because you've already taken that excess of 0.2 separately. So you just need to capture the 2.8 only. Then as far as the asset is concerned, the book value is 1.2. And as far as the gain is concerned, I think let's record the gain. The gain is supposed to be now 1.6 because you're selling the asset at 2.8 with a book value 1.2. So the gain is 1.6 and the sale is to the extent of 39.29%. So we'll record the profit on sale 1.6 into 39.29, that's 0.63 approximately. As far as the lease liability is concerned, that's 1.7 now. Though we can take the asset as a balancing figure, but we can still compute. The book value of the asset is supposed to be 1.2, and on the lease, we're retaining 60.71%. So we take 60.71% into 1.2, that comes to approximately 0.73. So let's see if the debits and credits are matched. Yes, it is perfectly matched. So this takes you to the entry for the sale and the lease back as well. Wow. So we covered the block one in terms of identification of lease, the block two in terms of separating the components and its accounting, the accounting focusing mainly on the books of the lessee, because lessor, I think there has been just one question which has come so far. And then in terms of the special accounting, I focus mainly on the sale and leaseback transactions. So that I think gives us the entire synopsis with some quick mind maps as well. I think this doesn't need a mind map. I think this is well taken because I think now you know the trick that you need to get the percentages. How do you deal with the excess? So if you want to create a three-step model on this area as well, you can say the step number one is to remove the excess, if any. The step number two is to get the percentages. And then the step number three is to put the journal entry for a sale and lease back. That also makes it a quick mind map in terms of step one, remove the excess, if any, from both the present value of lease payments and the sale proceeds. The step number two is organizing the percentages to get what is the sale and what is the lease. And then step number three, put the entry. And the focus in the entry in terms of the profit on sale is recognize the profit on sale only to the extent of the percentages. Recognize the ROU asset only to the extent of the percentages. That makes it a three-step model. I think I can quickly make a quick mind map on this as well. You want me to make a quick mind map on that? I think I'll do that. Since I've given you a couple of mind maps, let's make a quick mind map on this area as well, which is on the sale and leaseback so that it gets embedded in the mind. Very nicely explained. Thank you. So this is on sale and leaseback. You know, when the moment you go step by step, life is simple. So I would say in terms of the step number one, what you need to do, remove the excess. Remove the excess, if any. You need to remove the excess, if any. And what is that excess? It is the sale minus the fair value, the sale price minus the fair value. That is supposed to be the excess. So you need to remove this excess out. And where do you remove this excess? You are going to remove this from the sale proceeds. You need to reduce this from the sale price. That is one. And you need to remove this from the present value of lease payments. That is two. So before you proceed with the question, do this removal of excess at the very first stage. Then you go to the step number two. And in terms of the step number two, you need to get the percentages. You need to take the present value of lease payments as a percentage of fair value. And this represents the lease, or you can say the loan. This represents the lease or the loan. And you can say the remaining percentage. The remaining percentage is what represents a sale. So sale and leaseback, I always say, is supposed to be, you can say, a permutation combination both of a partial sale and a partial lease. And then finally, in terms of the step number three, you need to put a journal entry. And I think there are two focus points in terms of the journal entry as well. So the focus point number one is when you book the profit on sale, you need to consider the total profit into the given percentage which we have computed. This percentage is the percentage of sale. And the second input is when you record the ROU asset, it is supposed to be the carrying amount of asset. It is the carrying amount of the percentage into the percentage, and this is the percentage computed here. So these two percentages will be of your rescue when you go to calculate the profit on sale and the value of the ROU asset as well. Right, friends. So I think mind maps made, the run through of the standard is done. And I think that's what our time also permits so far. So we are done with the revision of Indes 116. But what you need to do now, sit down and do some more questions from this area, because I think we have made a walkthrough of the major areas of this standard. Once you do them all in a go, I'm sure you'll feel more confident in terms of this standard as well. Right, friends. So I think that's all. If you've got any questions, please go ahead. So salute to your teaching, truly regent of FR. Thank you very much. In pleasure, you make my day for that. But I think before we end for the day as well, I think since we're going to meet post Diwali, my best wishes to all of you, to your family as well. A very happy Diwali to you and to your family as well. May it brings a lot of prosperity to you as well. So I thought I'll just wish that before we leave for the day. I'm enjoying the class. Thank you very much indeed. Thank you for the Diwali wishes as well. Thank you once again and wish you once again to all of you. Right, friends. So on that note, I think we end the day. So see you next week with another bank standard. Interesting. I think financial instrument is on the way. Very interesting standard indeed. I love that. Right, friends. Thank you very much. Bye bye and take care. Haji, thank you.